Taiwan Semiconductor. Guys, there's a lot of talk about China invading Taiwan. There's a lot of frustration about this. There's a lot of concern about this. This is something that's out there. The question is it overhyped? Is this concern being exaggerated? I don't know. But what we're going to teach you in this video is we're going to teach you that you have to factor in these concerns when looking at a company. When you buy a company, you're buying all their future cash flows, and every investment is the present value of all those cash flows. And when you buy a stock, you're buying a piece of a business. You're not just buying a ticker. So this video will go over a lot of beginning stuff, entry-level investing stuff, and a little more complicated. It'll end with us going over analyst estimates and making assumptions about the future to determine what price to pay using our stock analyzer tool, okay? This is all of our software back here. Now, remember what we are. We're value investors. Our goal is to find companies where there's mispricings, where the market thinks that the company is worse than it actually is. When we can find that, we have found a situation in which it makes sense to make a long-term bet on the business. Our goal is not to get in and out of companies. Our goal is to sit there, look at companies, buy them, and if the stock falls less, as long as our thesis is the same, we want to accumulate more shares. Now, it's easy when the market's out there throwing news at you, because remember, news follows the stock price. Look at Meta. When Meta was at $88 back in November, Zuckerberg's an idiot. They screwed up Metaverse. Now it's $260, $270 a share. Zuckerberg's a genius. They're figuring everything out. Come on, 7, 8 months? Everything changed 180? Guys, these are major corporations. Those things don't happen that fast. All right, let's pull up Taiwan Semiconductor, TSM. Their stock, year to date, up 41%. This is a $540 billion market cap business. What does that mean? If you bought all the outstanding shares at current market price, you'd pay $542 billion. Now, guys, look at this. Enterprise value is exactly the same. That means essentially there's no debt on the company after you factor in cash. That's what enterprise value means, all right? So, some other things about the company. Up 178% in the last 5 years, up 481% in the last 10 years. That's pretty big stuff. That's pretty big stuff there. Let's go over some news for Taiwan Semiconductor. They're building a $40 billion factory in Arizona. I read something that said that the chips that are made overseas are about 30% less than ones here. So Taiwan Semiconductor making a factory here will increase the cost of those chips. But that's a big investment in the US and starts to eliminate a little more concerns between Taiwan and China and their relations. Another one. Semiconductor chips make up 15% of Taiwan's total GDP. Taiwan is really focused on the chip industry, and that makes up 15% of their GDP. That's a big number, guys. Our GDP is around $28 trillion, $27 trillion. That's the equivalent of am I right on this one? $4 trillion in GDP made up by chips, putting the same percentage on ours. That's big stuff. All right, now a couple of bull and bear cases about Taiwan Semiconductor. Bull case, 85% of the worldwide semiconductor startup prototypes were enabled because of Taiwan Semiconductor. That's big, 85%, guys. Another one, excluding the memory segment, Taiwan Semiconductor controls 30% market share in the foundry semiconductor space. Foundry being they make the conductors for everybody else, the semiconductors for everybody else. Intel is building their foundries so that they can make chips for other people as well. Now, bear case. Oh, right here. Chips made in the US could end up costing 30% more than the ones made in Taiwan. Okay, makes sense. Guys, remember, I talk about this all the time. Things cost more to make here because we are a wealthier country, because the average person is wealthier than other countries. And that's a good thing for us. Now, we're obviously making chips overseas is cheaper, but again, would you rather have higher wages here or make more stuff here? You can't make a lot of stuff here with high wages. Number two, Apple makes up 23% of Taiwan Semiconductor's revenues. And if Apple continues to expand in making its own chips, that will absolutely affect Taiwan Semiconductor. Apple is now transitioning in this whole, let's make our own chips. Part of the reason probably is because where else they can get growth from. So they have to see growth in some fashion, and maybe making their own chips is a way to do that. So these are kind of important things for Taiwan Semiconductor. And I want everybody to remember, 2021 to 2022, Taiwan Semiconductor fell from 142 down to 60%. That's to $60. That's a 58% drop in the stock price. And the reason I bring that up is When companies sound exciting, they say, oh, it'll never fall that much. Look at a company like Google. I remember doing videos on Google at 150 saying, we're interested below 100. People said, it'll never be below 100. Yeah, it hit 83, 84. Now it's back up again, but it took this massive bull market since this year started in the top 7 stocks for that to happen. Okay. Just remember, patience is your guide. You're not supposed to invest in every single investment you see. We're here to go through this company and go through the high levels, low levels, the more intricate details, the more basic things to show you that when you buy a company, you're buying a piece of a business and every investment is the present value of all future cash flow. So let's check out some more on Taiwan Semiconductor. So their current PE is 16.7. Their 5-year PE is 28. Okay, look at this profit margin. Much higher profit margin in the last year than they had over the last 5 years. Now remember, the chip industry had a lot of demand recently, and that could be a big reason for it. Their gross margin is 60%. That's pretty big. 68% is Microsoft, which is a software business. What this means is for every dollar they sell, 60 cents goes to basically pay their fixed overhead and their income taxes. So if they want to increase revenue by $1 billion, they probably don't have to increase their overhead by that much. So almost 600 million of that would go to their bottom line before paying income taxes. That's pretty big. Now, return on invested capital here, 12.4%. Not the greatest, but a lot of times growing businesses, well, it's not even growing. It's 74 billion in revenue. Geez, oh, Pete. Man, oh, man. I'm kind of surprised by this 5-year return on invested capital being so low. What is this 5-year return on invested capital? This is the return the company gets on the money that's invested in the business. A business can be funded through debt and through equity. So borrowing money from people or bringing investors in, either through your own money or other investors. And the 5-year return on invested capital is the return you get on those two areas. And big moat businesses, the market average is 9 or 10%. Companies with big moats have much higher ROICs. Microsoft's at 25%, Apple's at 38%. It's hard for companies to maintain a high return on invested capital unless they have a really good moat. That means it's harder for people to enter their business. Okay, let's check out the 8 pillars on the company. So remember, if you have our software, you can edit your pillars to be up to 12 pillars. There's like 4 quadrillion different variations. And as the software gets better and better, you'll get more and more variation in this. But right here, we have 8 pillars. We have 6 check marks. The 2 X's are the 5-year PE and the 5-year price of free cash flow. First thing I don't like, this 5-year PE is a lot lower than the 5-year price of free cash flow. I usually like it inverted. This means they're showing more profit than free cash flow. That's kind of alarming for me. I don't know why that's the case, but there could be a reasonable explanation. I don't know what it would be though. Shares outstanding is the same. Cash flow growth, net income growth in the last 5 years, revenue growth in the last 5 years, low debt, as we said before. So there's a lot of positives here, but this is very alarming for me. Very alarming for me. So I'm gonna go check out their income statement and see what's going on here. Let's go to annual because they're an international company. Okay, $14 billion average net income. The revenue growth, okay. 31 billion, 33, 34, 43, 51. Okay, let's look at their cash flow. Annual cash flow. Oh yeah, much different. Man, that's so surprising. So surprised, almost half. And that makes sense. That makes a lot of sense in terms of the numbers we saw, but I don't like it. I really don't like this. I like to base my investments off cash flow because at the end of the day, cash flow is harder to manipulate than earnings. Earnings has SEC rules, accounting rules, all these other things that happen. Cash flow is harder to manipulate. Is it still possible? Absolutely. But it is harder to manipulate the free cash flow number. So I'm going to focus on free cash flow here. Let's see what analysts are saying about the company. Oh, actually, I'm surprised it only went out 2 or 3 years. They're expected to make $1 per share this year. And for a company selling for $100 a share, that's not very great. And they're expected to increase to $1.46 in the next 2 years. Revenue is expected to go from $73 billion to $100 billion. So that's good growth. That's great growth, but it doesn't go out that far, which I'm kind of surprised about. This is very interesting. So let's look at a couple pieces of news about Taiwan Semiconductor. Anything that I want to sit there and talk about? Actually, really not much, except for those two stories that I talked about before, the $40 billion factory in Arizona. God, that's a big investment. $40 billion factory. Wow. I mean, what's that going to lead to in terms of investing? In terms of their investment? So in order for them to justify a $40 billion investment, what return should they make on that? I mean, I'm looking at saying they should be able to make an extra $6 billion a year in order to justify that of net operating income after tax. $6 billion. So based on their bottom line of 40%, in order to make $6 billion, you divide by 40%, that's $15 billion in revenue. So you expect them to justify this of increasing their revenue by $15 billion just from that investment. I'm doing base math here of saying, okay, if they make an average on the bottom line of 40% and they need to make $6 billion, that means $6 billion divided by 40% is $15 billion in revenue. That's what they need to make off that investment to really justify it for a 15% return, because we don't want them investing at 5, 6, 7% returns. That's not going to give enough money to the debt holders and equity holders. If I own part of the company and my cash is in the business and they say, hey, we're going to go invest your cash at a 5 or 6% return, I'd say, whoa, give me the money. I'll pay the dividend tax and I'll go reinvest it at higher rates. That's the key there. That's the key. If you own a piece of a business and they have your cash and they're only investing it at 5 or 6%, they're not doing a good job for you. So right here, I look at this going, yeah, I don't know about that. I don't know about that number. So so there's a couple of red flags for me so far. This difference between price to free cash flow and the PE and this $40 billion, I would do some research here to determine what do they expect to make off that $40 billion investment in Arizona. That's the big thing there. All right, let's check some more out here. We looked at analyst estimates. So now let's just go to the stock analyzer tool. Now guys, for the stock analyzer tool, this is the most popular part of our software. It was used 1.3 million times last year, but our software includes so many other tools that we haven't even gone over. Retirement calculator, 8-pillar search, 8-pillar portfolio, real estate calculator. Oh, it's here. That's great. So this is our real estate. And guess what, guys? If you sign up now, you get the real estate calculator in here. But soon, we're going to make it its own separate piece. So everybody who had it before will be grandfathered in. So you got to sign up now. $7 for 7 days, $1 a day at everythingmoney.com. And the biggest part is our community of thousands of like-minded investors. It allows you to have people around you to discuss investing with, because investing can be a lonely journey. And the hard part is finding like-minded people that can talk to you about the things. And guess what, guys? When I say like-minded, our process is like-minded. We disagree in here all the time about every investment. There are people in there who believe in crypto, and I don't believe in crypto. There are people who defend Tesla. I don't defend Tesla's valuation. That's the key. It's this discussion that helps make your analysis better. So let's do our assumptions about the future for Taiwan Semiconductor. They have a declining ROIC. Sick. Wow. Okay, so revenue growth. 10-year analysis. I'm doing a 10-year analysis here. I'm going to do revenue growth of 4, 8, and 12%. I'm going to do profit margin of 35, 39, and 43. So basically what I'm doing here, guys, I'm looking at the last 10 years and thinking about the industry too. And saying, okay, this company's large. They have $70 billion in revenue. Can they really grow at really high growth rates? These are the questions to be asking. Now, free cash flow margin. Oh boy, look at this, guys. It's so much lower historically. I don't like this. I'm only going to focus on my free cash flow margin here. So let's go 18, 20, and 22%. PE, don't really care, but I'm going to go 15, 18, and 21. And same with my price to free cash flow. Now, my desired annual return. So first off, to recap what I did here, don't make your assumptions on PE and price of free cash flow based on where it is today. That's what Meet Kevin did with Tesla. He's like, well, it's a 300 PE now, so 70 is a discount. No. Look at the company versus what the entire market does. And the historical average is 15 or 16 for the entire market. Now, should you pay a premium for some companies? Absolutely. That premium should be based on growth potential and the return on invested capital. And as those are higher, you should pay a bigger premium, because a company that's going to grow 20% a year, all things equal, versus another company 5% a year, you should pay more for the 20% growth, all other things equal. That's the big key there. So my desired return, I'm going to do 12, 14, and 16. Now, the reason I started at 12 here, there's still these issues with Taiwan and China and what could happen there. What if China does invade Taiwan? I got to be a lot more patient for my investment to work out. So I'm going to put in a higher return. And I don't like the fact that these numbers are so different. There could be a very logical reason. And this is a question for the investor relations and for our community here. Somebody I'm sure here has researched this to determine that. But that's very important. But as I went higher in my assumptions, I increased my desired return. So I'm going to hit the analyze button. The stock's currently at 104, 105. Okay. Boom. Now, like I told you guys, I'm focusing on my free cash flow number. A low of 34, a high of 70. If all the low assumptions occur and you pay today's price, you're going to make about a negative 2.35% return. If all the middle assumptions occur and you pay today's price, about a 4% return. If all the highest assumptions occur, you pay today's price, you still make 10%, but it's based on the highest assumptions occurring. Is that really the kind of investment you want to make? And that's what we discuss on this channel. That's why our channel is different. And that's why this software is so useful. It shows you what your assumptions lead to in terms of today's price. And if you bought at today's price, what return you'd make based on those assumptions. So guys, again, everythingmoney.com, check it out. $1 per day for 7 days to try out our software. Trust me, it'll be the best decision you make for your financial future for $1 per day. Take care.